Come to question number 43. Alpha's investments include subsidiaries, beta and gamma. The statement of profit or loss and other comprehensive income and summarized statement of changes in equity of the three entities for the year ended 31st March 2016 were as follows. So this time you have to prepare consolidated statement of profit and loss and consolidated SOCIE. So the name of the subsidiaries are beta and gamma, alpha, beta, gamma. Revenue, note 3 and 4, we'll read later. Cost of sale, note 1 and 3, 1, 2, 3. Gross profit, distribution cost, administration expense, investment income, finance cost, profit before tax, income tax expense, profit for the year, other comprehensive income, item that will not be reclassified to profit or loss. Under that, gain or loss on financial asset designated at FVT OCI. Note number 5, but the amount is nil. So after reading note number 5, we will see what is that. Right now it is nil. Then total comprehensive income. Then we have summarized statement of changes in equity. Summarized statement of changes in equity. Then we have opening balance on 1st April 15. Comprehensive income for the year, dividend paid, tick mark. Dividend paid by subsidiary received by parent. So it will have an effect in investment income. And balance on 31st March 2016. Note number 1. Alpha's investment in beta. On 1st April 2004, Alpha acquired, 1st April 4 means long back. Now we are in 31st March 2016. So long back. Alpha acquired 80% of the equity share of beta and gained control of beta. Alpha paid $64 million in cash for these shares. On 1st April 2004, the net asset of beta had a fair value of $70 million. None of the assets and liabilities of beta which existed on 1st April 2004 were still assets or liabilities of beta on 31st March 15. Alpha measured the non-controlling interest in beta using the proportion of net asset method. So first we will have to find out the net asset, which they have given in the problem, 70 million. So NCI will be 20% of 70 million, 14 million. Is it right? The resulting goodwill on acquisition of beta was correctly recognized in the CFS of Alpha. No impairment of goodwill on acquisition of beta has been necessary up to and including 31st March 2015. So no impairment of goodwill. On 31st March 2016, the annual impairment review of goodwill on acquisition of beta indicated that the recoverable amount of the total net asset of beta, including the goodwill, at that date was $180 million. We have done one similar adjustment in previous problem. Okay. When NCI is measured using proportionate share in net asset method, then you will have to first gross up the goodwill, then take total of carrying amount plus goodwill, compare it with recoverable amount. In case of impairment loss, you will calculate parent share only in that. Beta is regarded as a single cash generating unit for the purpose of impairment. Any impairment of goodwill will be charged to cost of sales. First, you have to find goodwill. Okay. For that, you have to use that entire paragraph. And then you have to also find the impairment loss of goodwill. And that impairment loss we will transfer to cost of sales. Note number 2, Alpha's investment in Gamma. On 1st October 2015, Alpha acquired 60% of the equity share in Gamma. Underline 1st October 15. And what is the year ending date? 31st March 16. So at the beginning of current year, okay. So current year full profit you will add. Beginning of year means 12 months you will take for the current year profit and loss account. Gamma had 50 million equity share in issue on 1st October 2015 and has not issued any shares since that date. The acquisition was financed as follows. Alpha issued 2 new shares to the former shareholders of Gamma for every 3 shares Alpha acquired in Gamma. What is the share exchange ratio? 2 share for every 3 share. So 2 share for every 3 shares means how many shares were issued? 2 by 3. And how many shares they have acquired? 60% of 50 million. 60% of 50. So these many shares were acquired into 2 by 3 and multiplied by issue price. What is the issue price? The fair value of an equity share in Alpha was 2.80. So the consideration paid in the form of share is 2 by 3 into 30 into 2.8. Is it 56? $56 million. The story is not over. And it says the fair value of equity share in Gamma was 3.70. So that will be required for NCI valuation if they want on fair value. Alpha agreed to pay a total of 24.2 million to former shareholders of Gamma on 30th September 2017. Now 30th September 2017 means it is a deferred consideration. Deferred consideration is 24.2. Payable after how many years? 2 years. Discount rate is how much? So present value of deferred consideration would be 20 million? 20. This also you will add in consideration paid. Alpha agreed to pay a further amount to the former shareholders of Gamma on 31st December 2019 if the cumulative profit of Gamma for 4-year period on from 1st October 15 to 30th September 19 exceed $150 million. This is called contingent consideration. Okay. Right now we are applying IFRS 3 for calculating purchase consideration. Okay. How much is contingent consideration? Read further. The condition is that you will be given how much extra amount? A further amount if the profit exceeds $150 million. On 1st October 15, the fair value of this obligation was $40 million. On 31st March 16, the fair value was remeasured at 42 million. So that 2 million change we will transfer to profit and loss account. Okay. Why assumption? No, this is fair value of consideration. So if nothing is given, change in consideration will be transferred to P&L account. So no need to write also. This is just normal change in fair value. So this is my consideration paid to acquire Gamma, 56 plus 20 plus 40. How much is that? 116. So sometime you have to apply other standards first. This is the application of IFRS 3. Next line, Alpha has resolved to use the fair value method for measuring NCI when recognizing the goodwill on acquisition of Gamma. So now you have to add here NCI also. How many shares are held by NCI in Gamma now? 20. And what is per share value of Gamma? 3.70. Multiply to 74. This is the value for this company. So NCI plus parent company's consideration paid together is how much? 190. Right? So this will be required for goodwill calculation. Then it says on 1st October 2015, the fair value of the net asset of Gamma were same as their carrying amount in the financial statement of Gamma, with the exception of property whose fair value exceeded the carrying amount by 25 million. And out of this $10 million of this excess relates to land. The estimated remaining useful life of the building element of the property on 1st October 2015 was 20 years. So building we will depreciate. How many years are over? 1 year is over. So for 1 year you have to provide depreciation on building. Incremental amount 15 million you have to provide depreciation. What is the date of acquisition? Year ending date is March. Okay, sorry, March. So 6 months. 6 months. All calculation will be for 6 months. Next line, plant and equipment whose fair value exceeded the carrying amount by $8 million. The estimated remaining useful life of plant and equipment of Gamma on 1st October 15 was for 4 years. 8 divided by 4. Okay. And again you have to take 6 months only, 6 by 12. So that is the extra depreciation we are going to charge in the post acquisition period. Okay. So this will help us to calculate the goodwill. Is it right? You have to find net asset. Using net asset, you have to find goodwill. But how do you know the net asset now? My question is, how will you find the net asset? They have not given us the net asset. So for that, you have to go to that statement of changes in equity. If you go to statement of changes in equity, there you will find that 1,30,000 is the figure on 1st April, and comprehensive income for the year is 33,000. So take half of that also. So that will give me net asset book value on 1st October. And to that I will make two adjustments. One, for the increase in the value of property, and second for increase in value of plant and equipment. Is it right? So can you guess what is the fair value of net asset on 1st October for Gamma? Exact amount. Fair value of net asset of Gamma on 1st October 2015. Take 1,30,000 plus half of 33,000 plus 25,000 and plus 8,000,000. Haji. 179,500. So 179.5 is the fair value of net asset. So there will be a goodwill of 10.5 here. Is it right? So the whole discussion will help us to find out consideration paid, fair value of net asset, goodwill, and in post acquisition period you have to provide extra depreciation. Next line, all depreciation of property, plant and equipment is charged to cost of sales. You can assume that profit is accrued evenly over the year. So you can divide profit 6:6 ratio. Next, note number 3, intra-group trading. Alpha supplies a component used by both beta and gamma. Alpha earns a profit margin of 10% on these supplies. Detail of the sales of the component and the holding of the inventory of the component of the group entities are as follows. So this will affect revenue, tick mark revenue. This will affect cost of sale for elimination of sale and purchase. And this will also affect your cost of sale because there are some closing inventory. Okay. Closing inventory is also there. Opening inventory is also there. So unrealized profit on closing stock add to cost of sale. Unrealized profit on opening stock reduce from the cost of sale. Now it seems you have become champion. You are not required to be explained anything. Now tell me note number 4 what you will do. Now here they have introduced IFRS 15 in your calculation now. Okay. Revenue of Alpha. On 1st October 2015, Alpha sold a machine to a customer for a total price of $51.2 million and credited $51.2 million to revenue. As a part of the sales agreement, Alpha agreed to provide annual servicing for 4 years. From 1st October 15 for no additional payment. The normal selling price of this without any annual servicing would have been 60 million. Only machine will go for 60 million. And Alpha would normally charge the customer an annual fee of $1 million to service the machine. So 1 into 4, 4 million. You would ignore the time value of money in respect of this transaction. You would ignore time value of money with respect to this transaction. Now what you have to do, there are 2 performance obligation. IFRS 15 says identify performance obligation, identify consideration, allocate the consideration in respect of standalone prices. So can you allocate 51.2 in the ratio of 60:4? 48 million and 3.2. This 48 machine has been delivered, performance will be recognized immediately. So this should go to revenue immediately. And out of this 4 year of service to be rendered, 6 months service we have rendered. 6 months. So 3.2 divided by 4 into 6 by 12. How much revenue should be recognized for service? Point? That's it. So my total revenue to be recognized should be how much? 58.4, 48.4. How much excess revenue you have recognized? You have recognized 51.2 minus 48.4, 2 point. So 2.8 we will defer. This is deferred revenue. We will adjust 2.8 from the revenue. Okay. Sorry. So this was application of IFRS 15. Alpha's other investment. Apart from its investment in beta and gamma, Alpha has one more investment in other entity X. Alpha purchased this equity investment on 1st July 2015. What is our accounting period? April 15 to March 16. Okay. So 1st July 15 for 40 million and designated the investment as FVT OCI. In order to protect against a prolonged decline in the fair value of investment in entity X, Alpha purchased a put option to sell this investment. So IFRS 9 will apply now. Okay, hedge accounting. The cost of the option was $6 million. So you have paid $6 million for this option as premium, and the option was regarded as an effective hedge against a prolonged decline in the fair value of the investment in entity X. On 31st March 16, the fair value of the equity investment in entity X was 37 million. You had purchased for how much? 40 million. Decline in fair value 3 million. So that 3 million we will show in FVT OCI section. Okay. And the fair value of the put option was 8.7 million. So you paid 6 million and now it is 8.7 million. So what is the gain on put option? Fair value gain 2.7. Both these items we will show in OCI. Apart from recognizing the investment in entity X and the put option at cost, Alpha has made no other entries in its draft financial statement. So we'll pass two entries. One, OCI account debit to investment account 3 million. And second, derivative account debit to OCI account 2.7. Both figure will be presented in OCI. Okay, not in P&L account. Alpha has made no other entries in the draft financial statement. Alpha wishes to use hedge accounting whenever permitted by IFRS. All of the investment income of Alpha has been correctly recognized in the individual financial statement of Alpha. So that means there is some income recognized from subsidiary. When was dividend paid by subsidiary? December 2015. Will Alpha receive dividend from Gamma also? Yes. In one previous problem, it was no. because that time the dividend was paid before the acquisition. In this problem, dividend is paid after the acquisition. So I'm going to make adjustment for both the dividend. Reduce dividend income received by parent in the statement of profit and loss, and dividend received by NCI reduced from statement of changes in equity from NCI column. Next line, bond issue. On 1st April 15, Alpha issued a convertible zero coupon bond to a single institutional investor. The bond was issued for total proceed of 250 million and will be redeemed or converted into equity share on 31st March 2020. So you have to take the present value of this. If the investor chooses to redeem the bond on 31st March 2020, the investor will receive 362.32 million. The incremental borrowing rate of Alpha on 1st April 2015 is 10% per annum. The present value factor is 62.1 cents. So is it a compound instrument? The answer is yes, because there is an option to buy. How much is the present value at 362.32 into factor is given 0.621. So this is the liability component. We are applying IAS 32 here. This becomes a compound instrument. How much is that? 225. And how much is the proceed? 250. So the equity component will be 25. Equity component will be 25. Not only that, on this 225, you have to charge effective interest, that is 22.5, because it's one full year. That also we have to charge. Next line, required using the information given in note 1 and note 2. Compute goodwill arising on acquisition of beta on 1st April 4 and gamma at 1st October 15. B. Prepare the consolidated statement of profit or loss and OCI of Alpha for the year ended at 31st March 2016. You do not need to consider the deferred tax effect of any adjustments you will make. Right? Very good. Okay. Now you have learnt all the tricks. Even if they ask, you can do it. You are champion now. Prepare this summarized consolidated statement of changes in equity for the year ended 31st March 16, including a column for the NCI. You should show all workings to the nearest dollar in thousand. So all your answer will be based on dollar in thousand. So first you complete this table. Calculation of goodwill on acquisition of beta and gamma. Try yourself. Already discussed with you completely. Only fill in the blanks. Calculate goodwill for beta, goodwill for gamma, Okay, dear student, check the answer. First April 4, how much cash was paid for acquiring beta? 64,000. 64,000. Explanation not required. Non-controlling interest, 20% of net asset. So here in explanation column, you write 20% of, how much is that net asset? 70 million. So in the answer column, write 14,000. And then net asset on the date of acquisition, 70,000 is given. This was also given. So what is goodwill on acquisition of beta? 8,000. Then in gamma, share exchange 2/3 into 60% into 50 into, what is the rate? 2.8. So final effect 56,000. Deferred cash consideration 24.2 divided by 1.10 to the power 2. So how much is that? 20,000. Contingent consideration fair value on the date of acquisition. Fair value on DOA, date of acquisition. Is it 40,000? So non-controlling interest, multiply 20,000 into 3.70. How much is that? 74,000. Net asset on the date of acquisition. Now for that there is a calculation. On 1st April, it was 1,30,000. Okay. Then 6 months profit. Take half of 33,000. 16,500. In explanation column, you can write 1/2 of 33,000. And fair value 25 for property and 8 for this plant and equipment. So that is 33,000. Okay. These three number you put in bracket. Now tell me, what is the goodwill on acquisition of gamma? Add this first 4 item minus these 3 items. You will get goodwill. How much is that? 10,500. So some marks will be allocated for goodwill calculation also. Okay. 8,000 for beta, 10,500 for gamma. Beta's goodwill has been impaired. So all other adjustment we'll discuss later. Gamma's goodwill is not impaired. Now, dear student, come to P&L account. Revenue. Working note 1. Go to working note 1. Now, in this problem, be careful. Alpha, beta, take full amount and gamma take 6 months. 6/12. Shares were acquired on 1st October. Year ending date is 31st March. So tell me the total of alpha, beta and half gamma. Haji, 6 lakh? Is it 6,65,000? Yes. $6,65,000. Come to working note 2, where we have to write how much service revenue will be deferred. So this discussion we already had, so we can use it now. What is the actual price of that entire machine plus service package? So right here 51,200. And sum of the fair value of individual component, 60,000 for machine, 4 into 1000 for service, so it comes to 64,000. So what is the proportion of actual to total? 80%, 0.80. So service revenue will get an allocation of 80% of 4,000. The total amount apportioned towards service revenue is 3,200. And out of that, 6 months service you have consumed, which means out of 48 months, 6 has been consumed. So how many months are still pending? 42 months. Or you can write 3.5 divided by 4 years. This much revenue will be postponed, deferred. It relates to future. So it comes to 2000, how much? 800. Anyway you present, don't bother. So now you write here, inter deferred service revenue which will be deferred for future period, 2800. And in the note number 3, that also I will do immediately. Intra-group revenue, 15,000 from beta and 8,000 from gamma. Note number 3 in that small table. We remove 23,000 here. So now tell me, what is the net revenue to be shown in SOPL? 639,200. And you come to this cost of sale working note also. Intra-group purchases eliminate 23,000. Second effect of this. So let us come to main page 639,200. 639,200. Revenue write down 639,200. What is the next item in the profit and loss? Cost of sale. So working note 3, first line, alpha plus beta plus half gamma. Alpha, beta plus half gamma. How much is that? Is it 4 lakh? Okay. Next is gross profit. Will not write now. What about distribution cost? No adjustment? Very good. Come to the main page. 2 full 1 half. Okay. 2 full 1 half. How much is the answer? 43,500. Same thing for administration also. 2 full 1 half. 58,000. Investment income working note 5. Let us come to working note 5 on the screen. Investment income 19,800 write down. First 19,800. And then intra-group dividend eliminated from beta, we received 80% of 12,000. So how much is 80% of 12,000? 9,600. Very good. And from gamma we received 60% of 11,000. How much? 6600. So net income to be shown in P&L account. Anybody? 3600. 3600. You write in main page investment income 3600. Then finance cost. Finance cost. First you come to working note number 6. Add alpha, beta, half gamma. How much? 35,500. Okay, we'll come back to this working note again later. After finance cost, PBT, income tax expense. Income tax expense, you write directly in the main page. There is no adjustment. 2 full, 1 half. How much? Haji? 32,500. Because they have said don't make any other adjustment in tax. Now next is profit for the year. Other comprehensive income. Item that will not be reclassified to P&L account. Loss on financial asset designated at FVT OCI. We can do that now also. Because we have discussed when you purchase the asset, the cost was 40 million. At year end, it is 37 million. You want to designate it as an FVT OCI instrument. So the loss will be recognized 3,000 in bracket. And to protect this loss, you have used a put option. And put option was purchased for 6,000. That was the fair value when you acquired. And now the fair value is 8,700. So there is a gain on derivative 2,700. Then total comprehensive income later. Profit attributable to owner of alpha, non-controlling interest, and again total comprehensive income attributable to owner and NCI. So this we will write later. Statement of changes in equity. That also we'll do later. Okay. Now revenue is over. Come to cost of sale working note. In cost of sales working note, we have to make adjustment for two items. One, unrealized profit on inventory, and second, extra depreciation on fair value adjustment of certain assets. Where is unrealized profit adjustment in the note? Note 3, closing inventory, the third line below. 3,000 in beta's book, 2,800 in gamma's book. And they have purchased it from alpha, who earns a profit margin of 10%. So 10% on sales we will assume, okay? So it comes to 580 plus or minus plus. Opening inventory is 2,000 only in beta into 10%, 200 negative. Okay. and this 200 will also affect my figure in statement of changes in equity opening balance. Remember that. Beta goodwill impairment we'll discuss little later. Extra depreciation on fair value adjustment we can do now. 25,000 is the total increase. Out of that, land element is 10,000. In property, total increase is 25,000, land element is 10. On land, we do not provide depreciation. So therefore, I will take 15,000 only. Life of the building is 20 years, divide by 20. Number of months in the current year from the date of acquisition till year ending date, 6 months, 6 by 12. 15,000 divided by 20 into 6 by 12 is how much? 375. So my cost of sale will go up by 375. Plant and equipment increase in the value is 88 million. That is 8,000. Life is 4 year. Divide by 4. This is given in note number 2 towards the end. And 6 months are over out of 12 for the current year. Proportionate time period allocation. How much is the answer? 1,000. Very good. Any query on this? No. Now we have to calculate the impairment of beta goodwill. Similar to previous problem. That note was dictated to you in the earlier problem. Is it right? So as a homework, you will copy that same note again today, which was dictated in the previous problem. Now come to impairment of beta goodwill. What is the net asset of beta on 31st March 2016? From where will you get this figure? SOCIE given in the question above note number 1. In case of beta, there is no change in the value of the asset. Do you know that? Purposefully they have given this adjustment. Otherwise, you will have to first prepare a statement of net asset for beta. But in case of beta, there is no change in the value of asset or liability. So same figure we can write here, 1,74,000. From SOCIE. What is the source of this SOCIE of beta? Center column. Last line. Goodwill grossed up. 8,000 divided by 80%. Is it 10,000? That note, write down note. Refer note in the previous problem. So my total will be 1,84,000. When NCI is based on proportionate share in net asset, and recoverable amount includes goodwill, then we have to gross up this goodwill figure. How much recoverable amount is given? Note number 1. 1,80,000. Very good. Note number 1. So gross impairment is 4,000. This 4,000 will be allocated between parent and NCI. NCI will not get any hit because it is based on proportionate share in net asset. Parent will take a hit of 80%, that is 3,200. 3,200. So what I'll do, I will write 3,200 here. Working note number 3, impairment of beta goodwill, reference working note 4. Now can I take the total of cost of sale? Say yes. Yes. What is the total? 381. 955. Three eight one 955. Okay. Go to the main page. Right here 381 955. Okay, so now let us come to next working. Investment income done. Finance cost. But before coming to finance cost, we should come to working note number 7 and 8. Okay. Working note 7 and 8 first will complete. So we can transfer the figure to working note 6. Okay. Now let us remember that while acquiring Gamma Limited, there was a deferred consideration of 20,000. Was it there? And on that 20,000 deferred consideration, we will provide interest at the rate of 10% because this 20,000 is the present value. So we have to provide the interest. And this year, how many months interest will be provided? 6 months. So what is the finance cost on deferred consideration? Is it 1,000? Okay, write 1,000. And this 1,000 you transfer to working note 6. Now you come to working note 8. Working note 8. Can you see working note 8? Under that working note 8, first line, liability component of convertible loan. Total amount payable is 362,320. Payable after 5 years. So the present value will be 362,320 into 0.621. 2,25,000. Who has issued this loan? Parent or subsidiary? Parent. That means interest will be charged for full year because this loan was taken on 1st April. So interest will be charged for full year. How much it comes to? 22,500. 22,500. Write in the working note 6. 22,500. Now only one adjustment is pending in working note 6. If you remember, contingent consideration is 40,000 we have recognized. And now the fair value of contingent consideration at the end of the year is 42,000. Is it there? Underline. So somewhere you have to adjust that 2,000 change in fair value. So there are two options. One is you can adjust in finance cost, or alternatively you can adjust in administration expense. So where do you want to adjust? Can we adjust in finance cost? So write 2,000 here. Note written, tutorial note. It would be acceptable to show the change in fair value of the contingent consideration under a reasonable alternative expense heading such as administrative expenses. Any query on finance cost? First we have written all three companies, change in contingent consideration, finance cost on deferred consideration, and finance cost on convertible bond. You have to visualize exactly what item will go where. So today as a homework, practice all questions. Tell me the total of finance cost. 61,000. Right, 61,000. 61,000 in the main page also. $61,000. Now tell me, wait, what is gross profit in this problem? 257. 245. And what is the profit before tax? So distribution cost you put in bracket, administration cost you put in bracket, investment income plus this finance cost in bracket. So tell me now PBT. 98345. Income tax expense put in bracket. So profit after tax for the year 65 65845. So this is my profit after tax. And then minus 3000 plus 2700 will give me total comprehensive income for the year 65545. 65545. Okay. Now you will tell me what is the NCI share in the profit after tax. 35 958. One more try. My question is, what is NCI share in the net profit after tax? On this amount on the screen, what is the share of NCI? And to help you, I have prepared a working note 9 also. 13250. One student is right. So now you explain. How did you reach that magic number? Profit after tax of beta is 36,000. And this is how much? Half. Half will take. So total we can write later. Then in case of gamma, we have to provide for extra depreciation. In their books we had provided extra depreciation. So this total of depreciation effect is how much? 1375. 375 and 1000. I have written this number also to help you. What about the unrealized profit on stock? Parent company. All interest etc. Parent company. Goodwill impairment, parent company, because proportionate share in net assets. So relevant profit for NCI calculation 36,000 and 15,000, and then respective share 20% 7,200, 40% 60, total 13250. Is it right? Now immediately we'll complete one more working note. Okay, first let us put this in the right place. 13250. So come to this main page. Non-controlling interest, write down 13250 over here. 13250. So what you do, take 65,845 minus 13250 will give you owner of alpha share in the group profit. Anybody wants to volunteer an answer? 52595. Very good. 52595. And then come to total comprehensive income attributable to. Now in the OCI, there are two items. One is change in value of financial asset, one is change in value of derivative. Both these transactions were concluded in whose book? Parent's book. So NCI will not be affected. So no working note. So therefore NCI as above means 13250 because NCI has no role, no share in this two adjustment. Both adjustments were made in the books of parent only, correct? Now again tell me balancing figure. This time take 65,545 minus 13,250. So the answer will be 52,295. If they only ask you statement of profit and loss, this much you will write. But they've also asked you to prepare statement of changes in equity. So for the opening balance, 1st April 15, on 1st April 15, we had only one subsidiary. Is it right? So I will find out what is the group and what is NCI on 1st April by going to working note 10 and 11. In working note 10, Alpha's own opening balance will come. Where is Alpha's own opening balance? From where will you find this figure? SOCIE, 2 lakh. And then Alpha's share in Beta's post acquisition change in net asset. Alpha's share is 80% and change in Beta's net asset since acquisition. So at the time of acquisition it was 70,000 given in the note number 1 second line. And now if you see opening balance 1,50,000. Can you see 1,50,000? So 1,50,000 minus 70,000. 80,000 has been the change since acquisition until 1st April 2015. Our share in that, our share in that 80%. So how much is that? 64,000. Okay, now one important adjustment which sometime we may forget. There is an opening provision for unrealized profit. Go to working note 2 and from working note 2 tell me what was the opening provision for unrealized profit. Is it 200? On opening stock 200 rupees. Reduce. So now tell me this figure. 263 800. 263 800. Wait a minute, come to just working note 11 below. Opening NCI in beta. What is the method you are using? Proportionate share in net asset. Opening net asset is 150. Yes or no? Can I take directly 20% of that? Say yes. 30,000. And there is one more way you can do it. For those who want to try the other route, on the screen, on the date of acquisition, tutorial note below that, it was 70,000 into 20%. If I want to follow this method, then also you are welcome. You will get same answer, 14,000. After acquisition, there is a change of 80,000 into 20%. Is it 16,000? Say yes. So therefore, if you see, your answer will be the same, 30,000. Okay. So dear student, come to SOCIE first line. SOCIE first line on 1st April 2015. Working note number 10. 263,800. NCI 30,000. So total was 293,800. Next is increase due to acquisition. Now this is again important. What is the NCI on the date of acquisition? For that you have to go to first working note where goodwill calculation was done. NCI on the date of acquisition of Gamma. Can you see 74,000 there? Yes, wait. I have an important question to ask. How much will you write in alpha group column, or you will not write? Did alpha group column we have to write something or no, don't write? One student is saying don't write. That will also change because you have issued the shares. To acquire Gamma, you have issued shares. So you kindly go to working note 1 again, and if you issue shares, your equity will also increase. Yes or no? So how much is the figure for issue of share? 56,000. So go to working note 1, you will find 56,000 there. So that 56,000 is due to issue of shares. So 56,000 you write here working note 1 or goodwill working, whatever you want to write for your understanding. This figure is taken from that goodwill because you have issued shares. And then equity element in bond issue. Come to working note 12. In working note 12, total proceed of bond issue was how much? Tell me fast. Total proceed of bond issue was how much? 2,50,000. And out of that, how much was loan component? 2,25,000. So how much is equity component? 25,000. So now you write here equity element of bond issue 25,000. Next is comprehensive income for the year. Now from where will you get this figure? Previous table, last two numbers, 52,275, 52, how much was that? 275 or 95? 52,295. And NCI was how much? 10,000? 13,250. Total column is your homework. Dividend paid. Dividend paid by Alpha. How much is dividend paid by Alpha? No, dividend paid by only Alpha. 30,000. This you will find in SOCIE. Reduce. And NCI share in dividend reduced from NCI. So total dividend paid by Beta was 12,000. Out of 12,000, NCI share is 20%. That is 2,400. Okay. So there is a working note number 13 for that. So let us go to 13 number on the screen. Beta NCI share in dividend 20%, 2,400. Gamma's NCI share 40% of 11,000, 4,400, 6,800. Okay. Main page. Last adjustment pending now. 6,800. So what is the last line? Alpha's group 36095. NCI total 477545. Sure. Take total of other figure also. How much is this second line total? 25,000 after that. And what is this comprehensive income total? 655. Dividend. When the subsidiary pays dividend, their net asset decreases. Is it right? So the NCI's share in the net asset will also decrease to that extent. Then is this answer over? Any query? This chapter is over.